financial inclusion is a journey. And as you heard from Amina, typically it starts with having an account, but it's only a start. True inclusion is about regular usage of fit-for-purpose financial product that will enable you to access services, enhance your livelihood, or maybe grow your business, and then stay resilient to shocks, and most importantly, gain agency and maintain agency over your life. So as Marcos in a previous session talked about where the impact investment space is moving and where the opportunity. As Gaurav said, I would like to go a little bit deeper into how financial inclusion space has evolved over the last decade, especially for the poor, and also explore what we can do to move the capital to the places that are needed. And we'll start with some numbers. In 2011, 10 years ago, only 1.5 billion out of 3.7 billion adults in low and middle income countries had an account. That's about 40%. And this is already a significant progress from a decade before. And 10 years later, that number doubled. Now 71% of about adult population in developing countries have an account. And it is a significant progress because financial inclusion starts with having an account. And this progress is partially thanks to innovation like mobile money. So this progress is partially due to innovation, but largely thanks to equity-driven efforts, meaning the efforts that are really focused on equitable access to financial inclusion by development actors, governments, and in some cases, corporations. But having an account, as I said, it's only a start. Zooming into a country like Kenya, I used to live there, and there, access to account is pretty high. 80% of adults have an account. But as I said, it doesn't mean that they use a financial product. Out of these 80% of people, only half of them have ever borrowed from a formal financial institution or mobile money. And if we take the mobile money out and a limit to just borrowing from a formal financial institution, number drops to about the 20%. So 80% of adults have an account, but the people in the middle here, they don't have access to a diverse range of financial product. Also, there are gaps. Finance isn't reaching the people equally. So in same country in Kenya, if we break down the number for men and women, the number looks like this. Women are less likely to have an account and even less likely to use a range of financial product. And the numbers generally looks even worse in many other countries. The gap is even bigger. So why do these gaps exist? Are the certain segment of customers, in this case women, are bad customer or worse customer than others, and it doesn't make sense for financial institutions to serve them? So to get a perspective on this why question from the view of our financial service providers, we have interviewed about 120 fintech companies across developing countries with international finance corporations. As the stock of a starting point, we asked, what percentage of your business customers are women-led? 63% said less than 25%. We also asked what percentage of your retail customers are women. About the majority also said less than 25%. And it's not surprising. This data is very much in line with what we observe in the big statistics about ratio of men and women using digital financial services, despite the fact that women are equally eager to use the digital financial services as men. We also asked the questions to fintech company what they think about women customers. First question, do women default more or less than men? Actually, more than majority. Majority said, no, women default less. Are women less loyal than men as a customer? No, they are more loyal. 69% of fintech said women are loyal customers, sticky customers. Then, are women's value for the farm less than a man's value? No, that's not true. The majority, or almost the half, said women brings the greater customer lifetime value than men. So women are not worse customers. So we again asked, is it expensive to bring women on board? So to this question, there are some companies that found the cost of customer acquisition is higher for women than men. And then some of them gave a specific example, like, if you onboard women on the digital financial services, KYC takes longer, you have to spend more time to explain how it works. Yes, it might be more expensive, but that doesn't seem to be the case for almost 2/3 of the fintech companies. So why are they not serving women as much as men? There are some reasons from a customer side that, I don't want to use these services, or my partner or community doesn't allow me to use these services. But fintech company also gave us these reasons. We don't really understand what women want, and it's easy to continue with what we already have. Or they are a small part of our customer base. Why do I make an effort? Or we gather the data, but we haven't thought about how to analyze them. Why would I? The social norms are so hard, doesn't really worth investing in. And we have a lower NPL for women, and they are good customers, but when the risks and the crisis hits, they can be risky. So these are true risks they see, but also perception of a risk that they feel, and a lot about not knowing how to serve them, or thinking it's too hard to think about it or do it. And their bottom line is they're not motivated enough. When we speak to banks, so this is from fintech, but when we speak to banks, we hear pretty much the same thing. So for financial service providers to serve this valuable but underserved segment, this challenge needs to be addressed, whether that's a real risk or perceptions. And it's not about having more capital. Yes, we need more capital, but at least it's not just about having more capital. So now, what is development community funding for financial inclusion? Where the money going? So in 2021, $68 billion was spent for the purpose of financial inclusion. About 50% of this was the direct investment to financial service provider in the form of a debt or equity. And 17% went to government as a debt or grant to build the market and regulate the market. And about the remaining 1/3 were everything else. Some of them are used for market building. Others were reinvested into financial inclusion, the financial service providers. But the bottom line is, a large chunk of funding is just channeling a capital to financial institutions. And then didn't we just say that the capital alone will not make it? So how can we make smart, equity-driven investment and unlock existing capital? Because capital is already there. We see various levers being used and are tested and are scaled and unlock more capital through financial institutions who already have capital. And I would like to share a few examples from our clients' work. Guarantee African Development Bank's President Champion Initiative called Affirmative Action for Women in Africa, AFAWA, has various instruments including guarantee to unlock more lending to women-led enterprises. Last month, I was in Abidjan with EcoBank, who said that they used this capital, used the guarantee to pilot new lending to women-led enterprises, achieved much higher repayment rate than expected, now convinced the management who are willing to build the business case to expand this lending to women-led enterprises. Second example, recent innovation in incentivizing banks to reach underserved customer is spearheaded by our client, Aceli, an organization that provides banks with the bonuses when they lend and onboard and serve the new customers. And in Dalberg's work to assess their impact, we are hearing a story such as these bonuses is motivating banks to go out of their business as usual and are reaching a customer as agribusiness SMEs in the rural area, hard to reach ones. The third example, Gates Foundation is partnering with European Investment Bank to provide a capital to bank in their local currencies. Typically, hard currency like a dollar loan from a foreign DFIs raises cost of capital for banks. Cost of capital for banks, which then becomes the higher interest for the end users. And it's been one of the major reasons why people like Amina would shy away from banks and stick with lending groups. This local currency lending will address the affordability of our credits, and we hope that this will bring more customers into the formal financing. And there are examples of a technical assistance going in. But these instruments I introduced has a potential to deeply employ equity lens and unlock the capital that are already there. But only tiny portion of funding is dedicated for such instruments. So let me go back to the same chart. You saw this earlier. And only 5% goes to guarantee, and only 1% goes as a grant to financial service providers, which can be used as incentives or technical assistance. Maybe some of other grants might get rechanneled into financial service providers in a similar way, but that is not enough. There is an opportunity to make a smart development with a stronger equity lens to unlock the large amount of capital. Marcus may say it's not enough, but I think there is a little bit. And then that can be unlocked. It's already there, and it can be used for people like Amina. And I would like to invite you to explore that.